Good morning, everyone. This is Toni Turner, and welcome to the market now as of about 10:30 a.m. Eastern on Friday, February 26th. Before we start, I hope to see you at the Orlando Money Show taking place next week on March 2nd to 4th. I'll be speaking on the 4th, and for more information, please go to moneyshow.com and click on conferences. And now on to the market. Wall Street was higher this morning after data showed that a slowdown in U.S. economic growth was not as bad as expected. Gross domestic product increased at a 1% annual rate instead of the previously reported 0.7% pace. The economy grew at a rate of 2.0% in the third quarter. The market was also lifted by a near 4% spike in crude prices. Global stocks rose as China reassured the world leaders at the G20 summit that it would not devalue its currency again, but look at other means to support its economy. Finally, the S&P is on track for its best two-week performance since last February. It's been staging a recovery from one of the worst starts to a year ever. Now let's look at three charts that could give us some insight into the week to come. First of all, as we usually do, we're looking at our trusty chart of the S&P 500 Spider, symbol SPY. This is a daily chart, and this is the ETF that closely follows our S&P 500 index. Now, when we look at this chart, we know that this dotted line here is 2016, the beginning of the year. We know the S&P has fallen pretty dramatically here. Fell down to January 20th lows here at about 181 or about 1810 on the S&P 500 itself. It moved up, back up to about 194 or about 1940 on the S&P index itself. Moved back down to about 181 and then rallied back up where we are so far today. This small red candle indicates that the SPY gapped higher at the opening and is now red or lower than the open. It looks like attempting to fill that gap. So what we have here is basically the same range. We're still in the same range we've been in since pretty much the second week in January. The range, I've put the caution line up here, or the wouldn't it be nice if the market went over it line up here, the yellow zone here. It's very important right now that traders and investors know how to read even just the most basic, simple support and resistance zones, because they could be very, very important. What the market does in these zones is very important going into the future, indeed the rest of the year. So right now, as you know, we've been trading in this zone going from between 181 up to 195 today, touched 196, but couldn't stay there. And maybe it can later this day or next week, but right at the moment, it's a little weak here. And that's because the what I call mad and angry people are all up here. The people up here who bought the S&P above 200, maybe up to 210 and even higher, every time this index, or this, I should say, this ETF pushes higher, these folks all say, hey, I think I'll get out now, and especially if they bought up here, I'm going to get out now so this thing doesn't go any lower. Because people do have memories, even if they can't read charts, investors have memories of when the market tumbled in January and again in February. So it depends on if the supply coming in here can be absorbed by the demand that's moving the market up. This is all a big fight between the bulls and the bears, all a big fight between supply and demand, and we're going to see who wins here. Of course, if the bears overtake it, if they say, hey, there's too much supply here and the bulls have to go back into their corner, then the SPY will head lower again, potentially next week. If the bulls are stronger, if they absorb more supply, then they may chase the bears away. So this line at 195, 196, this is kind of where the rubber meets the road here. If the market can go above it, then we may have a pleasant March. If it cannot, then we have to see where it can, if it can noodle around in this zone between, say, 187 and 195 until it can get the strength to move higher. So very important lines here, 195 and 181. Very important to watch for support and resistance. Our next chart is one, I'm kind of going off script this week. I'm putting in a couple of charts that I find interesting that aren't necessarily related to the indexes. This is the Select Sector Spider Healthcare ETF, symbol XLV. Top components in this chart, there's 58 holdings. Top components, I should say, in this ETF are Johnson & Johnson, Pfizer, Merck, Gilead, Amgen, United Health. I think healthcare has gotten pretty beaten up this year for a number of reasons. We don't have time to go in here, but I don't think that in the long run it's a place to ignore. As we can see here, the XLV, the Healthcare Spider ETF, came down and made a low on February 9th of $62.68. Since then, it's climbed back up over its 20-day moving average and back up to the green line, the 50-day moving average. Close is trading today at $67.71, $67.71. As is indeed some of the indexes, we can see the 50-day moving average is providing resistance here. We can see we have, well, if I could draw a straight line, we have price resistance at about the same place. So these two, price resistance, indicator resistance, are coming together. That's a convergence of indicators, and that is kind of an important signal. So what we want to see here, what I'm going to watch though, is I'm going to watch it. I'm not getting in it right now. I'm going to watch it for the next week. We have a support line here right down at 65. I'm going to see if the SPY, is it going to go back and forth here? Is it going to trade in the zone between 65 and say 68? Or is it going to be able to pop up and over this 50-day moving average back up over 58? And if so, it might be something I nibble on a little bit, because I think that in the long term, in the long run, healthcare is going to be one important place to be. Okay, our next chart today is the Spider S&P Metals and Mining ETF, symbol XME. We looked at this chart several weeks ago, and indeed it has edged higher from there. We have in this ETF, it's an equities ETF as well. Top components are companies like Newmont Mining, Hecla Mining, AK Steel, Consol Energy. Again, we looked at it. It edged up from where we looked at it. I've been looking at some metal stocks recently, and I kind of like what I see. They've been really beaten up. Of course, this is a bottom fishing play. The zone I'm watching, the XME, is trading above its 20-day moving average, the 50-day moving average, still below its 200-day moving average. So I'm watching it trade, the XME, in this range between 14 and just a little over 16, where it is right now as I captured this chart, $16.13. I'm wanting to see here, I'm not saying I'm going to purchase it yet, if it can, I really, from my lips to the XME's ears, I'd like it to pull back down around 15, if it would please, just above the 20-day moving average. And if it can do that and then start higher again and break above $16 and say 20 cents, then it be something I'm going to look at more closely. I think the industrials, they have really popped in recent weeks after a really tough beginning to the year. And some stocks like Alcoa Aluminum and some others have started moving higher after a pretty tough period of time. So keep an eye, continue to keep an eye on the XME. it may turn out to be much more interesting as time goes on. And now we're going to go on to next week's economic reports. But first, please join us this coming Monday online from 4:30 to 6 p.m. Eastern for our next session of Toni's Market Club. We'll talk about which side of the market to trade, have a mini trading lesson, and I'll give you stocks and ETFs that may become ripe for high potential trades. This is a low-priced, high-value opportunity to learn more about the market, become a smarter trader, and make more money. So please join us. If you can't attend our live session, no problem. The recording is available to all of our members just a few minutes after our session ends. And now for the coming week's economic reports. On Monday, we have the Chicago PMI and pending home sales. On Tuesday, we have the ISM Index, auto and truck sales. Wednesday, we have the ADP employment change, our weekly crude inventories in the Fed's Beige Book. On Thursday, we have weekly jobless claims. And on Friday, we have the very important monthly non-farm payrolls and unemployment rate. Again, join us for Toni's Market Club this coming Monday. Don't miss out on this fantastic opportunity to raise your trading knowledge and your trading profits. Until next week, keep green on your screen. I'm Toni Turner, and this is The Market Now.